Dear viewer, have you ever noticed something about every bull market? There is always one theme that everyone falls in love with. A few years ago, it was defense, railways, and PSUs, and today it is AI, data centers, and anything remotely connected to them. Now, there is nothing wrong with that. Big themes create big winners. But over the years, I have realized something. Many investors become so busy searching for the next hot sector that they miss something which is even bigger. A company that is quietly changing itself, becoming a better version of itself, and a better business than it used to be. And these are often the companies that create enormous wealth. Think about APL Apollo Tubes. 10 years ago, most investors simply looked at it as another steel products company. But the company was not standing still. It moved into branded structural steel solutions, built distribution, improved product mix, and evolved into a better business. The markets then started giving it a higher valuation. Or take Titan, a watch company that grew into a blue chip jewelry company, totally changing its identity and ultimately its perception and valuation in the minds of investors. The same thing happened with PI Industries, that investors initially viewed as an agrochem company. But over time, contract research and custom manufacturing became the real growth engine, making it far more valuable than a commoditized agrochem company. These companies belong to completely different industries, yet they all have followed the same script. They migrated from an ordinary business to a business with better economics, thus leading to better margins, better returns on capital, and better competitive positioning. And investors rewarded higher profits with higher valuations. Management thinker Adrian Slavodsky called this phenomenon value migration. Businesses evolve, customer preferences change, technology shifts happen, and new opportunities emerge. Smart companies do not wait for disruption. They move forward towards businesses where they can earn better returns. Such changes do not make interesting headline at the time they are unfolding. They start so quietly that most do not notice until such steps gain enough momentum to drive better profits. Only then the markets wake up. But by then, a large part of the wealth creation has already happened. That is why some of the best investment opportunities do not always come from discovering a new sector. They sometimes come from spotting an old company that is becoming a new business. I was reminded of this while studying Time Technoplast. Most investors know it as a plastic packaging company. It supplies industrial packaging used by chemical, pharmaceutical, food, and FMCG companies. It has a leading position in India, operates across 11 countries, and exports contribute roughly one third of its revenue. That is already a respectable business. But I do not think that that is the most interesting part of the story. You see, over the last few years, the company has been steadily increasing the contribution of what it calls value added products. Today, these contribute around 27% of revenue. Management expects this to increase to around 35% over the next 2 to 3 years. Here is why it matters. Its traditional products generate operating margins of roughly 13%. The newer value added businesses earn around 18% to 20%. In short, the economics of the business itself is improving. And that is the stuff long term investors should look for. The biggest driver of this value shift is composite cylinder business. They are lighter than metal cylinders, have better aesthetic appeal, and are safer and easier to handle. The company is already selling LPG cylinders and is now working on the larger household version with public sector gas companies while also exploring opportunities with private players. Besides, it is expanding capacity for CNG cylinders, which are expected to grow at over 25%. Other promising area includes hydrogen storage and hydrogen-powered mobility. Under India's National Green Hydrogen Mission, huge money is expected to flow into creating a green hydrogen ecosystem. While much of the attention is naturally focused on producing hydrogen, it also needs to be stored and transported safely under extremely high pressure. That creates an opportunity for specialized composite cylinders. Time Technoplast has already secured important regulatory approvals and has established an early presence. There are other signals worth noting. Over the past year, promoters have bought shares worth nearly Rs 149 million from the open market including purchases during 2026. In late 2025, the company also raised around 8 billion from respected institutional investors such as Aberdeen Access Mutual Fund, Edelweiss Mutual Fund, and others. Now, none of this guarantees shareholder returns, and there are risks to be mindful of, such as weakening of industrial demand, raw material price volatility, and long gestation period for new ventures like hydrogen related opportunities. This is not an investment recommendation, but the underlying message is the next multi-bagger may not come from the next fashionable sector. It may come from an ordinary looking company which is quietly becoming something extraordinary. What do you think? Let me know in the comment section. Thank you for watching. Goodbye.